Welcome to the weekly update, where I'll go over the action in the market for the week of October 16th through the 20th, and then we'll see how things are looking for the week of October 23rd through the 27th. We had a pretty significant down week. In fact, on our daily charts, we've switched pretty much over to negative now. We're negative and a little extreme negative in the short term. We're turning more negative in the intermediate term, and we've dropped below the 200-day simple moving average. So we've even switched over to negative in the long term. We're still working off of a golden cross that happened some time back, but the fact that we dropped below that level where it held up as support before, that's turning things more negative. Now, we could get that back because there's a lot of different levels kind of coming together at this point. There are other levels and other indexes that the market can latch onto, and I'll try to point those out in this week's video. Before I get started, please know that there's a PDF available in the description below this video, so you can download that and follow along with the slides and charts that I use. I do post pivot points each day on the community tab on the YouTube channel. They can be very helpful if you're deciding to go long or go short or get in or go out. A lot of times we can really use these points to get some ideas as to what will the market do once it hits one of these levels. I do have a private Facebook group. You're welcome to join. If you're already on Facebook, you can send me an invitation. I'm the only one that really posts there now. I'm trying to get the group up and going a little bit more, but it's really not happening yet. If you want to come to the group and try to change that, you're more than welcome to do so. I will be posting a new poll after I post this weekly video, and I'll be going over the results of this week's poll. And then I really keep an eye on YouTube comments. I don't get a lot of comments, probably because my videos are really structured around, okay, here's the evidence, here are the positive things, here are the negative things, and you can't help but come to the conclusion after looking at all this evidence. And so I'm not real dogmatic about saying this is going to happen or that's going to happen. And so people don't fire back with, well, I agree, I disagree. That's fine. And I really try to keep a close eye on the comments that are posted. I keep the garbage comments and the crap comments. Those get deleted right away. If you do want to offer something back, you're more than welcome to do so. Even if you disagree with some of the conclusions that I've reached, that's fine. You can state your opinion, or if you have something that you want to interject into that. I usually don't respond to comments where it's just a blanket statement where I can't really agree or disagree with what you're saying. I just kind of let those go. But if you have some kind of a response to me personally, go ahead. Also, at the end of this video, I give you an email address where you're more than welcome to come and maybe on a more private basis, be able to send me some information that way or your thoughts. Videos are also posted on Rumble. Here's the link to the channel. I also have that down in the description below this video, so that you can just click on that if you're having trouble finding me on YouTube at some point. All right, let's go back and talk about this week's session. We were down 2.39%, and volume was above average. Now, some of that had to do with Friday being options expiration, but we've been seeing, for the most part, above average volume pretty much every day lately. We're turning more negative now. We have turned negative on the daily charts. We're switching more negative on the weekly charts. And the big overriding factor is inflation and interest rates. Interest rates are going up. A large part of that is seen as a flight to safety because of what's going on in Israel. People are getting into the U.S. government bonds, feeling that they're giving a good return and that it's a safer place to put money. So when that stops happening, that had been pushing interest rates down. But when that money stops coming in, that means that bonds are getting sold. That pushes interest rates up. We actually went up over 5% on Friday with the 10-year yield, and we haven't seen that since about 2007. We dropped down below that and closed below that level, but interest rates are going up to much higher levels than what we've seen in quite a while. And a lot of it has to do with the geopolitical events that are going on in Israel. Also, we're coming into earnings season now. A number of companies have already reported. More will be reporting, and you get a big company, one of these mega caps that are going to come out and report, and that can set the tone, either positive or negative, pretty much for the whole market. Our trend is still weakening. We're below the moving average with our ADX indicator. It's negative. The red line's on top, and we're getting close to that 20 area. Now, it looks like we're just starting to form a trend on the daily charts. Our short-term and intermediate-term ADX indicators starting to turn back up and crossing above the moving average. However, they're still below 20, so we don't have a confirmed trend at this point. The trend that it is picking up right now has the red line on top, so both in the short and intermediate term, that's turning into a negative trend. We're also looking at a weakening negative trend on the weekly charts. So for the week, the Dow was down 1.6%. The NASDAQ, which has been a really stronger part of the market in 2023, not this week, it was down 3.2%. The S&P was down 2.4%, and the small caps were down 2.3%. So it was across the board, more of a broad-based retreat. So for the week, the stock market had a broad decline, which is being induced by the rise in interest rates and the Israel-Hamas war that's going on. You got a lot of people bailing out of the market on Friday because something can happen over the weekend like it did 2 weeks ago, and they don't want to be caught long or short if something positive or negative happens, so they just decide to get out of the market completely. The 10-year note, as I stated, it did get above 5% on Friday, but then it settled down at 4.92%. Still pretty high compared to what it has been historically over the last few years. Then on Thursday, Fed Chair Powell gave a speech, and when he read off his prepared remarks, the market kind of liked that. But then he was asked a question, and he said, well, there's not enough economic evidence yet that suggests that the Fed is too tight right now. That really spooked the market, and we ended up really declining after he made that statement. We still don't have a Speaker of the House for the House of Representatives. First you had Steve Scalise, then you had Jim Jordan, and who knows where it's at right now. There's really just a lot of speculation going on. We're also keeping an eye on the VIX. We're at the middle part of October now, where historically this is about the time when the VIX tops out and we start to go down in the longer range. Now, you notice here where we did decline and then it shot back up. It doesn't mean that the market's going to go straight down from here, but typically what we've seen from 1990 up to 2022 is that the VIX goes down. That generally means that stocks go up. We're also keeping an eye on inflation. We're going to get another gauge of that in the upcoming week with the PCE report coming out. But we're tracking along what happened from 1966 to 1982. We're about in the 1976 to 77 range right now, where inflation had been declining. But then right after that is when we saw inflation just go hyperbolic here. And if you grew up during that time, you remember those times very well, as I do. We're also keeping an eye on this, and I go over this in the daily video. This is RenMax research that they posted on Twitter, and then I just update what the current yield is for the 10-year, where whenever we go above 4.02%, right now we're at 4.92%, that typically, according to their research, we get over into this area where it's going to really start biting into company earnings because they're having to pay more for interest instead of using that money for profits. Let's get into the poll results for this last week. I only have 4 questions this time. And remember, this was a week ago. So I said the drop in oil and interest rates have been helping stocks bounce. That was a week ago. Do you feel that this has ended or that it will continue? 60% said, nope, we're done. Now the market's going to continue to decline. And that's what happened. 40% thought that it will continue. Then as of a week ago, Friday, October 13th, the S&P as well as other indexes have worked back to the point of equilibrium. We were at a tipping point a week ago. Do you feel that we'll go higher or lower from here? Higher. 86% thought that we're going to go up from that point a week ago. We actually went down, and that's what 14% said. And will the situation in Israel impact the markets? 80% said yes. 20% said no. And yes, it is having either an indirect influence because you have to look at oil, gold, the dollar, interest rates, and those things can all come through and affect stock prices, or just the idea that there's unsettled things going on in the Middle East that seems to be bigger this time than other times, and that can really produce some investors to get on edge as well. And then, do you feel the situation in Israel will escalate or de-escalate? Pretty much everybody, 83% said that it will escalate, or 17% said that it will de-escalate. It's probably hasn't escalated as quickly as a lot of people thought it would, but who knows? Maybe Israel's going in for the long haul. Maybe Hezbollah will end up getting involved there up in the north. And if they get involved, you have to keep an eye on Iran. There's also Syria. There's all kinds of things. How's that if Russia starts to get involved? Because Iran and Russia, they're not real great friends, but they're working together. What's that going to do to the Russia-Ukraine war? And then what's that going to do to the U.S. and NATO? So you have to really keep an eye on this to see if it does escalate and how much, if at all. Okay, and then getting to the next chart here, looking at some Isabel Net blog charts. These are just, I take a picture of this every week, but it's not changing really. This is just justifying why stock prices can go higher, because looking out into the future, whether you're Morgan Stanley or looking at the consensus, we're going up, looking out into the future, and earnings are ultimately what drives stock prices. Then looking at GDP, we're going to get the advanced report for GDP. That could be pretty big, and then that's coming out this week, where for right now, we're in the third quarter of 2023, and they think we're going to have positive GDP. We're looking out into the fourth quarter. It's still going to be positive, but Goldman Sachs isn't as rosy, where they tend to be the gray area here, where the black diamonds, that's what the other consensus is. But even going forward, we still have positive GDP, which is one of the definitions of a recession. When we are for 2 quarters negative GDP, that feeds into the idea that maybe we're in a recession. Then we did have the leading economic index come out this week. It's still below this red line, giving us that recession signal, but now it's starting to come back up. There are other indicators that we look at that are still holding up, and those mostly have to do with employment and spending and things like that. So that part of the economy still seems to be hanging in there, and that's also justifying the Fed from maybe even considering to raise interest rates. Then looking at retail sales, this is 70% of the U.S. economy. This chart's a few days old now, but we did have retail sales come out this past week. If we were really going to run into some problems, retail sales would be going down, and we've actually continued to go up. Looking at FactSet, they just had one blog post on Friday. This is just an earnings update as of Friday's session. The chart down here, I'm not sure is all that helpful. I'll try to read through this gobbledygook here in the middle. As of right now, 17% of S&P 500 companies have actually reported their earnings. So we're still early in the season. And those that have reported, 73%, have been above estimates, which is below the 5-year average of 77% and a little bit below the 10-year average of 74%. That's where it gets convoluted. So when you take it all together, the earnings are 6.6% above estimates, which is below the 5-year average and equal to the 10-year average. So we're hanging in there for right now as far as earnings are concerned. We're just in a difficult time technically looking at the charts and looking geopolitically at what's happening and dealing with the rise in interest rates. But earnings seem to be hanging in there, at least for right now. Now, that could change as more companies come out with their reports. Getting into our charts, this is going back to Monday, looking at the whole week together, where we were quite a bit higher. We were pretty much flat. We started to come down and play with the August 2022 high, which was acting as pretty good support. But then on Wednesday, that's when we started to break through it. Then up here, this is when Chairperson Powell came out with his statements that the market didn't really like, and we broke well down below this level. And then we just continued to go down in Friday's session. We came down to the 200-day moving average, but right at the close on Friday, we broke down below that. So as of right now, we've broke long-term support. Now, we're not very far away from that. We could gap up and get this back. There are also some other levels, as I talked about, that I'll point out in some of these charts. So for the week, and this is just the 5 trading days that we just finished, all of the indexes were down. You had the NASDAQ and NASDAQ 100 down the most. You had the Dow and the NYSE down the least, but they were all negative. Going back to the beginning of the year, we have the NASDAQ 100, the NASDAQ, and the S&P. These are the stronger areas. These are all made up of a lot of these mega cap companies that have really been helping the market lately, where all of the other indexes are now down going back to the beginning of the year. When you go back to the all-time high, all of the different indexes are down, with the small caps in the last place. they've really been under a lot of pressure. If you've been watching these videos for very long, you know that the NASDAQ and NASDAQ 100 for a long time were in last place. Well, the NASDAQ is in second to last, but then we go over here, and then now the NASDAQ 100, it's still down, but it's in second place, doing better than the other indexes. Looking at our sectors, we were down on the week, so I sorted this from what was down the most. Real estate, which continues to just get hammered. Discretionary, which has been a stronger area, but not lately. This is a little bit of a concern. This is one of those growth versus value areas where you want to buy low and sell high. And it had been performing quite well, but it's not doing well as of the last month or so. The financial sector got hit pretty hard. And we had two areas that were up: staples, which have been just decimated this year, and energy, which has been kind of roaring back a little bit and seeing a little bit of an improvement. It was just barely up for the week. Looking at the relative rotation graph, these are all the different sectors, the 11 sectors that make up the S&P. The strongest area right now is energy. That's XLE, where you have communication and discretionary and tech. These are the three areas that had been stronger, but lately have been showing some weakness. And we're seeing things like staples, real estate, industrials. These are showing some weakness, where some of the other areas have been showing some recent strength. But the only thing really strong right now tends to be energy. And that's, you could say, somewhat influenced by what's happening geopolitically, especially if things escalate. So looking at the sectors for the week, we had energy, staples, healthcare, communication, and utilities. They were up on the week, where a lot of these have been really getting hammered. All of the other sectors ended up being down. Going back to the beginning of the year, we have communication, tech, and discretionary. They have been performing the best. They're off of their highs, but they're still positive going back to the beginning of 2023. Going back to the all-time high, we still have energy, which is doing the best. Tech, healthcare, and industrials are positive. All of the other sectors still remain negative. Looking at sentiment, we're getting down to the point now where at 26, if we drop below that, that's going to be extreme fear, and sometimes that will end up marking a bottom. So we have one more solid down day, and we could end up dropping down to this area. You can see we're at the early part of October, we did get an extreme negative reading, and then we saw a bit of a bounce up out of that as stocks improved. Now we're starting to come back down again. And now there's no magic as to where we're going to stop here, but a lot of times we use this as a contrary indicator. And when everybody's freaking out, that's just about the time we look at doing the opposite. Looking at the active asset managers, where they had been extreme negative and we're showing some improvement, well, that's still continuing. Now, this data is anywhere from 1 to 2 weeks old, so it can be a bit lagging. Then looking at the most recent reading here, we're at 66.67 with the active asset managers. They're above 60%. They're not extreme negative or positive currently. Keeping an eye on the VIX, where for the first time in a long time, we actually closed above 20, both on the line chart and on the bar chart. And it took Friday's session to actually do that. So our Ulcer Index, which is another fear gauge, it's crossing above its moving average. And the RIDEX bear bull ratio, when this really spikes up, that means folks are getting pretty nervous. It's actually giving us a pretty bullish reading right now where they haven't freaked out. One thing to keep in mind, this is as of Thursday's close. It does not include Friday's session. There's a 1-day lag on this data. The most recent reading of the American Association of Individual Investors, they're pretty much neutral right now. Individual investors tend to react to what's already happened instead of proacting or getting ahead of things before they happen. And they're pretty much right around the 0 level, slightly negative. But when you look at this is a long-term chart going back to 2008. And when the black line is going down, that's positive for the market. That means that the tech sector is outperforming cash. And back in 2022, the black line started to go back up. That's when we had a lot of trouble. Well, we have bounced back up just a little bit now, but we're really far away from this Ichimoku cloud. We're not really in danger of really spiking up now, which would suggest that for right now anyway, when it comes to the tech sector, any pullback that we're seeing is not necessarily a real change in the long-term trend. Keeping an eye on the economy, we will get GDP this week. The latest reading, according to the GDP Now forecast, is that it will be up over 5%. This is rarely correct. This is just what they're doing to come up with a number. It's a little more accurate if you take the top and bottom estimates, where we have anywhere from 4.5% to about 2.5% to the downside. And then we'll see when that report comes out. This will be the first time the market is seeing this, so it could really have an impact. Here's another look at it on a bar chart showing how we're well over 5% right now with the forecasting according to the Atlanta Fed. I believe that's who puts this out. And then looking at the spread between risky and non-risky bonds, this would really be going up if there was a lot of fear in the market. We actually ticked down this past week. We have been going up, so yeah, I mean, there's some fear out there, but we're not really spiking up like we were during the COVID plunge or like we were back in the financial crisis. We have a long ways to go before we really get concerned with this chart. Looking at the latest reading of the Chicago National Financial Conditions Index, we get concerned when we go above the black line. We're actually going down right now. And some of these next charts haven't been updated for a while. This is as of the end of July. This just shows the banks are tightening their lending standards. And then we have the real-time SOM rule that hasn't been updated since the 6th of October. We only get nervous if it goes above the red line. We're just a little bit above the black line. The same thing with the smooth recession indicator, not updated since October 2nd, where it's barely off of it's pretty much right on top of the black line, not even near the red line. And then the Brave Butters, again, this is a little outdated now as of October 2nd. It is increasing a little bit, but the last reading that we had is not necessarily spiking. The one thing to be aware of with these charts is the delay in getting updates with this. This will be really great at telling us what we should have done, but it might be about 2 or 3 months too late before we actually get the information. Keeping an eye on inflation, and then this is recalculated every day, where this past week we had CPI come out. This upcoming week we're going to get PCE, and these levels will end up adjusting as that report is released. Keeping an eye on the Fed. You can't get much more absolute than this. As of Friday's close, October 20th, there's a 99.9% chance that the Fed is going to leave rates unchanged at the next meeting. That's almost absolute. But from here, it could only go down, and we still have a few weeks until that meeting actually happens. Here's the change over time, where the dark blue area, that's where we're at right now. Then we have a day ago, a week ago, and a month ago, and how the market has latched onto this idea that the Fed will not raise rates. We're also seeing the Fed balance sheet continuing to decline as things are falling off, like bonds are expiring and that are not being renewed and so forth. We can also see the year-over-year change as the balance sheet continues to go down. Then looking at the advanced decline line, we're still barely above the moving average here based on price, where we're dropping below the moving average based on volume. So we're getting a mixed picture here. We're still looking okay when we look at our new highs and new lows. The 4-week moving average continues to go up, as does the 10-week, but on the daily charts, we're really starting to see a real expansion of the new lows. And you can see that here. It's just not necessarily reflected in our moving averages. The advanced decline ratio turning more negative. The blue line, which moves faster, it's below zero. The red line is declining, but it's still above zero. Accumulation distribution. This is a bit of a concern. On the daily chart, we're dropping below the red line. We're also dropping below the red line on the weekly chart. That's confirming each other. That's suggesting that the smart money is selling right now. And then here's the condition of our trend, where the ADX is below the moving average. We're getting close to that 20 level, but we're still above 20. So we're in a trending environment. We're in a negative environment because the red line is on top and advancing, and the green line is declining. Here's the Arun, which really hasn't changed over the last week. It's showing that buyers are decreasing, but so are sellers, according to this indicator. We're still positive, though, because the oscillator itself is above zero. The mass index, we're not getting a signal right now generated on here. I'll show you the daily chart later in the video where we're getting close to a signal. Looking at the daily chart, where we came right down to the 200-day moving average. We're actually just a little bit below that. We did break this long-term support, or this trend line right here. That's quite negative. Where it had been providing some support for us to fall down here is negative right now. The thing that we're watching for is, are we going to continue to fall below the 200-day moving average, or are we going to find some support in here and be able to bounce back up? Looking at our longer term chart, we're getting right down to the midpoint of the trend channel going back to 2009. We had been a little bit above the midpoint, so that was more positive, getting right back down to the middle. means that the market's more non-committal at the current time. Then looking at the pivot points, where we did hit that pivot point back in July, and we've been having trouble ever since that time. But when you look at the longer term trends, the red line is still going up, even though the S&P has been coming down on this weekly chart. And you're going to see a lot of this as I go through these weekly charts. The S&P is still in a longer term uptrend, even though it's showing some weakness. The McClellan oscillator, which had turned positive and was looking a little bit better, it's now dropped below zero and is declining. That's more negative. And we're seeing a little bit of an improvement with the summation index based on price, but we're still below zero as well as volume. So negative, but showing some improvement. The Swenlin trading oscillator, we're declining below zero base, both with price and volume. That's negative. And we came down and actually got a really nice signal from the bullish percent index, but now we're coming back down again, and we may drop below this 30 level another time if we see more weakness. Looking at the PMO, on a weekly basis, we're negative pretty much across the board. The PMO is going down. We're below zero based on price and volume, even though we saw a little bit of improvement. We're in the process of turning more negative on the daily charts. And then looking at the PMO study, where we're declining with the PMOs that are rising, we're also declining with the buy signals. We actually are bouncing up a little bit with the PMOs that are above zero, but this is flattening out. We're not really getting a signal from the percent B. This is only measured when we close either above the upper band or below the lower band. The fact that we're below the midpoint and declining, that means the bias is negative, but we're not getting an extreme reading right now. Here are all of our oscillators together, where we're pretty much negative with our longer term trends. We're switching back over to negative on the daily charts. The chicken money flow finally really dropped down below. This kind of confirms what we're seeing with the other chart of the smart money, where it shows that there's a lot more buying, a lot more selling than buying. Well, we're also seeing that with this chart as well. The chicken oscillator is turning back down and could be getting close to an extreme negative reading, but for right now, it's just flat out negative. The force index is below zero and declining. That's negative. We're still below 50 with the money flow, even though it was showing some improvement. It ticked down this past week. The rate of change, we had a down week, so that shows that we're going down here. When we go back 50 weeks, well, we're still ticking up just a little bit. This looks at this week and then goes back 50 weeks ago, and it's still registering a little bit of a gain. The RSI is dropping below 50 and declining. That's negative. And we're getting more negative on the weekly chart. On the daily chart, which I'll show you later, the black line and the red line continue to be right on top of each other. The Stochk RSI continues to be extreme negative. The Williams percent R is also extreme negative. The ultimate oscillator below 50 and declining. The vortex, the red line is crossed above the green line. That's negative. The Copic curve is actually more negative now and dropping below the midpoint. In our longer term chart, we're starting to break below this red line. That's longer term support, but we still have a lot of really heavy duty support below where we're at right now. But that would be a pretty hellacious drop from here. Our different charts, we're turning more negative with the Heiken Ashi, where we have dark candles. We're negative, but we actually turned up a little bit with the Kegi. When it's red, that's negative. When it's pointing up, that's more of a positive bias. We're turning more negative with the Renko with a solid red box. And we're looking more negative with the 3-line break. We're dropping below zero and continuing to decline with the ease of movement. That's more negative. We didn't see anything new drawn in the point and figure charts because we've been in this territory before, so it's not enough to draw any new X's or O's yet on this chart. Our different trading systems. We're negative with the Elder's Impulse system on the weekly chart. We're negative with the parabolic SAR. And on the daily charts, a couple of days ago, we saw the dots also switch from bottom to top. So we're seeing confirmation of the negative trend here. Our PPO studies, we're declining in the long term. We've gone negative in the intermediate term, and we're also going back down in the short term. Some daily charts. This is the mass index chart that I was referring to earlier. It generated a signal at the end of August, but it ended up not really helping us. We're wondering if we go above this dashed line, which is what we're doing now, we get up to the blue line and then at some point roll over, come back down, and then cross below the red line again. That's when a signal is generated that whatever the market's doing at that time, this indicator thinks that there will be a reversal of that. Then we are, and I haven't shown this for a long time in any of the videos other than the deep dive video that I do, we're dropping below the 200-day simple moving average for the first time since last March. Looking at our daily charts on some fib levels, we broke down below the 100% retracement level on this chart. We're dropping below the 61.8% retracement level on our longer-term fib chart. Now, we haven't exceeded these previous lows that we set earlier in October and the latter part of September. That's another area where the market may find some support and be able to bounce up off of that. If we end up breaking down and closing below that, that could turn things more negative. And then longer term, we're coming back down. We're just 10 points away from this 42.14 area. If we break below this, we might also break below this other line, which is green and then blue. These are two Fibonacci levels on top of each other. So that just shows you that there's a real mathematical madness behind the market. So if we start breaking these levels, that could turn things more positive. We could find some support and be able to bounce up off of that. We're also getting kind of close, but not really, to the quadrant level here. I usually only show this lately in the deep dive video, but if we break this low, we might come back down. Now, this area has acted as support before, and then when we were coming up, it also acted as resistance. So we'll be watching for that. And here's a daily chart of our long-term trend. And a week ago, I drew this line up here from the high that we set and then connected the tops. And then I just drew a parallel line down here, which kind of breaks some of the rules as far as drawing trend lines. It's supposed to go from low to low, where I just drew it parallel. Well, look at where we're at right now. Somebody's looking at this too and also making decisions based on this. So this could end up acting as another support level, or we might end up breaking down below that. Here's the daily special K chart where we're still pretty much on top of the red line. And looking at the NASDAQ 100, we may get some support here. It's coming down to these previous lows right now. Will this end up being a support level that the NASDAQ 100 can bounce up off of? If the NASDAQ 100 is doing better, that means the S&P 500 is also doing better because mega stocks are in both of those indexes. Keeping an eye on the NASDAQ 100, we're coming back down to these previous lows. Right below that is the 61.8% retracement level. And then we're dropping below the 50% retracement level here on the NASDAQ, but we haven't exceeded these lows at least yet. Here's another thing that turned negative this past week, the Russell 2000 index. It did generate a death cross. We're looking negative with the RSI. We're also turning negative with the MACD. The mid-caps also generated a death cross and broke below support, but there's other support here that the mid-caps may find to be able to bounce up off of. The FANG index continues to fall below its 50-day moving average. And then going back to our arithmetic scale, we're down below this, where up until a few days ago, we were above this long-term trend line. We have also started a new 50-day cycle. It started on the 17th, and is that meaning that we're going to start going down from here? Now, sometimes this has marked a top or a bottom. Other times the market has just ignored this particular 50-day cycle. Keeping an eye on the broad market, where we're down 4.2% in September. And right now we're still up, but it's 2.5%. And we tend to be up 60% of the time in October. Here's just a look at the small caps, mid caps, and the S&P, where it just shows pretty much across the board weakness. We're seeing a little bit more weakness here in the small caps, and we're getting more concerned about the weakness that we're seeing in the mid caps. When you look at the Dow, yeah, there's some weakness, but we're still in a longer term uptrend, even though that's rolling over a bit. The NASDAQ continues to be in an uptrend, but showing some weakness. NASDAQ 100 still in an uptrend, but some weakness. Mid caps, if we continue to go here, we're going to have a death cross on the weekly chart where we've already seen one on the daily chart, but there are some support levels down here, even down a little bit further, that the mid caps might hit. And we're also starting to go a little bit below for the small caps, where we're now generating a death cross on the weekly chart for this index. The NYSE showing some weakness, but still in an uptrend. All stocks dropping down below this 50-week moving average. We're rolling over a bit, but we're still in a longer-term uptrend. The 30 biggest software companies, this is looking more negative. We haven't really broke to the downside yet, but the blue line is just about ready to cross below the red line. The FANG index also dropping below this blue moving average, but still in an uptrend. ARC also dropping a little bit further, still in an uptrend, but a weakening uptrend. The banks, which are not doing very well these days, dropping down based on price. We're declining with the RSI, rolling over with the MACD. Then you look at deposits where folks are still having a tendency to put money back in, but this past week, we actually saw outflows going into banks. Here's just a blanket chart of Dow theory. Traditional Dow theory is just the Dow and the transports, where we just look for divergences here. And we're seeing that the transports are really underperforming. They're going down a lot more uniformly than Dow has been doing. The utilities, which had just been getting decimated, and I included as part of Dow theory, we did see a bit of a bounce back up, but this last week saw some more weakness. Then looking at the broad market, the CRB continues to be in an uptrend. Oil, where it got up to 95, fell back. Now it's closing in the upper 80s. Copper continues to show some weakness, and we've already developed a downtrend on the daily chart. We're waiting for the cross here on the weekly chart, but it hasn't quite crossed over negative yet. The dollar continues to be pretty strong, and it is in an uptrend both on the daily chart and the weekly chart. Gold, man, it's just all over. This geopolitical events that are happening, we saw it really fall, then it's really been going up, and we're wondering, are we going to see a death cross here, or is gold really going to take off and start to go higher? We're seeing fairly similar action here where we've already seen a death cross with silver. And looking at bonds, where we're going down based on price, and we have a recent death cross. But when you compare stocks to bonds on a monthly chart, stocks are still outperforming. The 1 to 3 month yield is still negative, as it should be. And here's a daily look at the yields and how they've been changing over time. And here's a weekly look where you have the US having the highest rates, followed by the UK, and then German rates. Japanese rates are going up, but they're in a very distant fourth place. Some relative studies. Here's a look at intermarket analysis going back to the beginning of the year. Oil is now outperforming stocks, where the red line went above the black line, and gold is starting to outperform the dollar, where bonds continue to be quite negative. Going back to the beginning of 2022, we still have oil in the lead, followed by the dollar, and then gold, where stocks and bonds are still negative. The ratio between the NASDAQ 100 and the S&P is still holding up fairly well for right now. The S&P 100 continues to hold up against the S&P 500. Growth is still outperforming value. Gold, it's really shooting up now, but it has really been underperforming the S&P. It's still in a longer-term downtrend, but if this continues to go up, we might see more of a golden cross in the near future. And gold is coming back a little bit compared to the dollar, but the dollar's been strong, where gold has been weaker. But because of the geopolitical things going on in Israel, we're seeing gold starting to outperform on a shorter-term basis. Bonds continue to underperform stocks. The low volatility stocks are really starting to bounce back up as we're running into some more difficulties. So far, these previous lows have held with this ratio. Discretionary has been falling recently compared to staples, but still outperforming in the longer term. Energy has been bouncing back, but is still on a longer-term downtrend when compared to tech. In our long-term look in our secular and cyclical trends here, where the NYSE breadth thrust, that was triggered over a year ago now, quite a year ago. We're not quite to that point yet. And this is still on the books. So, and that's looking out far into the future. Or the SWAG NYSE breadth thrust, it was triggered last March. Even though it's dropped down a little bit more negative, it still continues to be on the books. This is a little bit of a concern. This Horchak method, it has been giving us a buy signal for most of 2023. With the weakness that we've seen over the last week, it's still positive, but it's dropping down from that strong buy signal. And then longer term, going back to the 87 crash, we're still below this long-term trend line. This is a weekly chart based on a log scale. This is a shorter term look at that same chart, just going back to the beginning of 2018, where we're below this trend line, and we've been below it for a while. And the NASDAQ 100 is also below the longer term trend line. The ratio between the NASDAQ 100 and the Dow is still giving us a pretty high reading. It hasn't really turned and started to fall, at least yet. Looking at the QQQs, which is the NASDAQ 100, and comparing them with the IWM, which is the ETF for the Russell 2000 or small caps, this still continues to be quite high, but we haven't come back up to where we were previously. There are other charts that show indexes that suggest that we've already topped out, because ETFs are calculated differently than indexes. Looking at some momentum, where the MACD on a weekly chart, it still continues to be negative. Then every day I go through Tom Bowley's research where we're in the middle part of October, where typically we see things more positive before we see things turn more negative, and then we see some positivity going into the latter part of October. So this is just for Monday's session. The UAW strike is still continuing. They still don't have a Speaker of the House. The Israel-Hamas war is continuing on, and they're wondering if it's going to escalate. Our technicals on the daily charts are negative, and we're possibly below long-term support. We're just right on that 200-day moving average, actually just a little bit below it. We won't get any economic reports on Monday. And then the geopolitical events right now, it's all about Israel and Hamas. Here is the new economic calendar for the week. We'll get new home sales on Wednesday. GDP is going to come out on Thursday, as well as durable goods. The big inflation report will be this coming Friday with PCE prices. Looking at the Stock Traders Almanac just for Monday, we're now entering into the week after options expiration, which tends to be more down than it is up. But we have pretty positive seasonality when you take all the years together. With the Dow, we're neutral to positive, where we're positive with the S&P and the NASDAQ. Here's a look at the 16th trading day of the month. That's what we'll see on Monday, where historically the green line, that's the S&P, we do see some positive action there, where it's more flat when we just look at pre-election years. And then I have a whole slew of different charts. This is showing the month of October during a pre-election year when the current president is running for re-election. Are we coming into that time where we see the market really start to go negative? Here's an updated chart from Carson, also wondering, are we still in this time here where we might see some more negative action before the end of October? This is a chart that I've been showing, and I tried to put the red square around where we're at right now. We're wondering, are we coming into that weaker time before we see a bounce up out of this? This other seasonality chart going back to 1950. Also, are we coming into this weak time before we see a bounce? Then looking at the NASDAQ during a pre-election year, we tend to see some weakness before we see a bounce in October. We also see some weakness before a bounce in the S&P 500. We're up a little bit more than down for the S&P 500 going back to 1950 and just measuring pre-election years. The scenarios that we're going with right now, you could lean towards the down one on the daily charts because the ADX is going above its moving average, but it's still below 20. So you may want to wait for some confirmation. There's really nothing to suggest to go up right now. You could still lean towards the sideways trend because the ADX is still below 20. The warning signs based on the daily charts and based on Friday's close, our longer-term equity put-call ratio is going up. That's negative for stocks. The 5-period equity put-call ratio that we use is also going up. That's negative. The risk-on posture is going down. That's negative for stocks. The oscillators, both for the S&P and the NASDAQ that we follow, are turning more negative. The vortex on the daily chart has switched negative. The 50-period new highs and new lows, an exponential moving average study that I do, that's below zero. That's negative. The parabolic SAR daily chart has switched negative. The Russell, that's one small cap index. The small caps and the mid caps have all generated recent death crosses. Then the longer term signals, it may be that we're at some kind of a top. Those are those weekly charts for the S&P and the NASDAQ 100, where we're still well below those trend lines. The cumulative new highs and new lows for the NASDAQ continue to show weakness, but that's gone on for a few years now. We're still above the yield that we were at on the 3-month. When we look back to 2007, we're wondering, are we going to top out there at some point and start to roll over? That's what it did right before the great financial crisis. It hasn't rolled over yet on the chart that we follow. And then we're dealing with earnings season, which can be either positive or negative. The positive signs on the daily chart, we're still wondering what's going to happen with the special K indicator. The BPI was looking better, but now it's starting to show some weakness. The Copic curve is generating a buy signal, even though that's rolling over. And the Pring bottom fisher, it's just merrily going higher right now. Small and mid-cap growth continues to be positive on the daily charts. The financial sector, which was able to get above its 200-day moving average, is now dropped back below it. The longer it stays below that, the more it may see a death cross. The positive longer-term signs that we're seeing seasonally and historically, when we look at those longer-term charts, when we look at what happens historically, this can be positive for October, and then it tends to be positive going into the end of the year. We just have to work through this time right now. But there's no guarantee that things are actually going to get better. We don't know what else is laying on the horizon. The long-term seasonality and those setups, they're still there for right now. The S&P is still above the downtrend channel upper line. I'll show that in the deep dive video. So our conclusion for Monday is that we're negative right now. A new trend is developing on the daily charts, and we're below long-term support. That's the moving average, the 200-period moving average. We're becoming a little bit extreme negative in the short term. We're turning more negative and losing support in the long term. And this is the first time in a long time we close below the 200-day simple moving average. That is turning things more negative. Thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.